Hi, my name is Dr. Renée Friedman, and I'm Global Head of Research at EXANTE, and I'm joined by Azad Zangana, Head of GCC Research at Oxford Economics. Azad, thank you for joining me today. I'd like to ask you your views about what is happening within the GCC region, what you see as the major risks, as well as the opportunities.
Yeah, well, we're about to actually publish our latest 2026 key themes for the region. And in that, we identify four in particular that we want to focus on. The first being that the consumer outlook looks incredibly positive, especially when you compare it to other emerging markets and other sort of peers around the world. You know, it's a very youthful demographics here within the GCC. And so many of the issues that we have around aging populations, rising tax burdens, the cost of healthcare, which is going up, isn't really an issue here. Instead, we have strong labour markets, we have rising disposable incomes, and at the same time, easing monetary policy, which is fantastic news for the region. We're also focused on what's going on with oil markets and the impact that that's going to have, because that raises potentially a risk for the region, given still the high dependence on oil revenues. We're also thinking about where the next infrastructure projects are going to be, and we've identified AI as potentially being the next tourism for the region overall. So there's a lot to delve into.
Absolutely. So particularly looking at this point, you mentioned in terms of currency. Now, obviously, many of the currencies in the region are pegged to the US dollar. With the weakening of the dollar, what do you see happening in terms of policy here? Would that eventually be separating? How long do you think it will stay pegged? What are some movements that are potentially affecting investor decisions?
Yeah, we see almost no risk of any kind of depegging in terms of currencies. 5 of the 6 GCC countries are hard pegged to the US dollar. Kuwait is the only exception which manages a basket of currencies with regards to how it decides to manage its currency. Where we probably will see some divergence is on interest rates. Because, for example, going into next year, we've got the Fed cutting rates maybe 3 or 4 times. We don't think we will see a one-for-one match in all of the countries. We do believe that, as I said, growth is going to be pretty strong, especially amongst the consumer sector. And that additional monetary easing isn't really a great mix with what's happening with the currencies in general. So in order to avoid any kind of risk of overheating and excess inflation, we think that when they start to cut, they will cut a little bit, but they just won't match the Fed one-to-one.
Okay. Now, beyond looking at the currency situation, which we know the Fed, is meeting this week in December, and markets are expecting at least this rate cut. We'll be looking very closely at the economic projections for other rate cuts into 2026. But there are other underlying issues that could be affecting the market here, and that's related to debt and debt dynamics. We know globally this has become much more pressing. We know in the US, the debt dynamics are not looking particularly good. In Europe, again, same situation. What about for the GCC states? Because this has come up a bit, particularly for Saudi Arabia.
Yeah, well, I think some people have been quite surprised by the amount of debt issuance lately coming through from Saudi Arabia. But in relation to the risks that we've just discussed around oil prices and oil generally being oversupplied to the market at the moment, what Saudi Arabia is trying to do is they're trying to smoothen out the path of their own spending through the use of debt instruments and debt issuance. It makes no sense to be totally beholden to the whims of international markets with regards to oil when it comes to year-to-year planning. Now, having said that, the deficit in Saudi Arabia is currently running at around 6% of GDP, and the latest Saudi budget states that they're looking to bring that back down to about 3% by next year. But the adjustment would be quite a bit worse if they weren't using debt markets to, of course, like I said, smooth out that expenditure, that infrastructure expenditure, especially over the next few years. Having said that, of course, debt across the GCC is still incredibly low. Yeah,
they're below 40% debt to GDP.
And these are gross numbers we're talking about. Of course, if you think about net and the amount of assets, there's no real net debt out there in the GCC. So these are still incredibly low-risk economies to invest in, but they are using the financial instruments that they have available to them to help manage their public finances.
Okay, and comparing that to, say, within the US market, which is obviously what most investors across this region do look at, what do you feel are the biggest risks given what is happening in the US, that we still have uncertainty around tariffs, that we do have the debt dynamics going on in terms of questions around debt sustainability, potential fiscal dominance as we look at a new Fed chair coming in at the end of May. The next Fed chair is likely to be far more dovish than the current Fed chair, Jerome Powell. How do you think that will play out for investors here?
So the transmission from the US monetary policy straight to the GCC is very clear in that it can come through directly through interest rates, because, as I said, the central banks here are trying to match the policy as closely as they can, but they can diverge, and we expect them to next year. It can also come through long-term interest rates and the back end of yield curves, not as closely related, but there is still a relationship there, given how important US Treasury market is to the whole world, for that matter. And of course, where there is a negative impact that ripples through the world, that can have an indirect impact through international trade and the strength of the global economy. But then finally, there's the US dollar, because if markets do become very concerned around US fiscal policy, then the dollar can take a hit. And of course, because those pegs are much stronger in the GCC, we'll see a depreciation also in those GCC currencies against the rest of the world.
And actually, for the GCC, given what it's trying to do in terms of the different countries' industrial policies, would that work to its benefit?
Perhaps in some areas, if you're thinking more around the non-hydrocarbon exporters, then yes, so you'd see some benefit from those kind of exports and trade. But at the end of the day, once you take hydrocarbons out of the trade balance, they are big importers. So it just raises the cost of living for everybody here.
Generally,
And at a time when, inflation is generally pretty low, we are expecting it to pick up to over 2% for the region overall in the next year. I guess the risk is it could be even higher than that if we get some uncertainty around the US dollar.
Of course. Now, the other big thing looking at this across the region is the growth of AI. And within AI, obviously, it is about not just the regulatory environment, but the energy infrastructure behind it. So given the limitations on the energy infrastructure within the US, we know that there is increasing level of demand in terms of gigawatt production and within Europe, but there's limited supply given the state of the various grids. How do you see the GCC responding to this?
I think the GCC is in a fantastic, unique position to take advantage of the needs and the restrictions that we're seeing elsewhere around the world. Governments have a very clear vision to try to expand investment amongst AI and to bring as much AI capacity to the region. They're focused on the infrastructure required, so the energy needs, the data center needs. Not only are they using your traditional provisions of energy, but they're also in particular focusing on clean energy as well, because they know that the carbon footprint of this kind of activity can be very high if not managed correctly. So they are using solar power, for example, as a way to try to minimize the carbon impact of these technologies. And that's going to be important, because not only do they want to use and utilize their own domestic capital to put into these companies, but they want to bring in foreign direct investment as well. And of course, we know that asset managers in Europe, UK, US, to lesser extent, they are also concerned about the carbon footprint. And so if you have a choice between clean energy provision and somewhere that isn't clean, they will choose the clean energy provision where they can. But that's not where they're stopping. They're also trying to bring in pragmatic regulations to allow these companies to grow and experiment freely without too much concern around regulation coming in and stopping them from certain activities. What's also interesting, and this is coming from my own personal view, having just recently put my children into school here, the amount of emphasis on AI in education provision here is amazing. Children are really being brought up to understand and use AI alongside their education process, so that they are enabled to take part in the ecosystem going forward. And I don't think we're seeing the same response yet in other parts of the world. So they're definitely much more advanced here in providing that.
Well, they've benefited from that technological leapfrogging in many ways. The next question I have for you is really around this point of geopolitics. It's been a very tumultuous year. A lot of that due to the tariffs imposed by President Trump. Those, of course, still remain to a large degree unresolved. They are still sitting with the U.S. Supreme Court. Regardless of that decision, we still expect some degree of tariffs to remain through other legal provisions that President Trump may use. But more importantly than that is that we've also seen over the course of this year, more than a year actually, that shift in geopolitical emphasis or influence. That slight movement between soft and hard power. Now, obviously, the U.S. is still, in terms of hard power, quite strong and still strong within this region. How do you see it affecting the wider shifts in soft power across the region and the relationships, not just with the U.S., but increasingly with trading partners in Asia?
I think the GCC governments have done a really good job in essentially appeasing the US government in managing that relationship. They've committed to increased defense spending. They've committed to purchases to help increase trade in both directions. And that has won quite a lot of favor. They've managed to reduce the effective tariffs applied to GCC exports to the US, even though the majority of those exports are hydrocarbons, which frankly wouldn't have faced much tariffs in the first place. They understand the importance of keeping the US administration on side. The real prizes have actually been access to the important AI chips, getting that inward investment coming into the region.
And the deal in terms of rare earth metals.
Absolutely. These are the big wins, not so much the exports to the US. So they've taken a pragmatic approach and they've understood that this is the government you have to deal with. And I think they've dealt with them very well. But at the same time, they've also managed a very good relationship with China and Asia more generally. So they've been able to straddle both sides very effectively. And I think that puts them in a really strong position to be very important, regional powers, but also from a sort of logistical perspective, a very important player for the world economy.
We've talked about some of the positives. Now, where do you see the particular levels of risk moving forward for investors within this region? And given what we're seeing globally, some of the changes we still have, and we will have into 2026, a high degree of volatility. We have geopolitical risk. We haven't ended the war between Russia and Ukraine. We have the U.S. Kicking off with Venezuela. We still have the tariff delay in terms of response between U.S. and China. We still the situation in the South China Seas and numerous other geopolitical hotspots around the world.
If I may, Renée, if you look at markets today, you look at spreads, our investors would be saying, what risk? There's no risk. Spreads are incredibly tight, yields are generally low, the currencies are doing okay, and equities are still doing reasonably well. So where are the risks? I think actually a lot of these big global risks have been around for so long that they feel priced within markets. Okay. Instead, we're focused much more on regional risks. We're focused on oil prices in particular, because we do see more than 2 million barrels per day excess supply out there today. And that normally would give you a 50, if not a 40 handle on Brent crude. Yeah. Now, we're not saying it's going to go that low, but we can certainly see a 50 handle, probably mid-50s by the end of next year. That presents a risk for fiscal policy. Absolutely. Because we can clearly see OPEC Plus have already decided they're going to freeze the re-expansion in output going into Q1. We think actually they'll carry on into Q2 as well, freezing right out till then, before eventually starting to expand output once again. That is going to really hurt. That means that getting the deficit down in Saudi Arabia means genuine re-examination of some of the big infrastructure projects that they've been doing, some of the big 2030 and beyond vision projects that they've been looking at. They're going to be scaling those back. And so, If you are a company or an investor who is very tied up with these kind of infrastructure projects, this is your major risk right now. Apart from that, we're also focused on the AI bubble that a lot of people are also talking about.
And you think it's a bubble?
I think there are concerns around the valuations. I don't, for 1 minute, doubt the demand that's out there. But I do think too much capital has chased those few stocks, and not enough has looked at the wider economy and, in fact, the wider infrastructure that goes around the use of AI in particular. Now, if we do get quite a big correction, what does that do to the region, given that the region's really heavily invested and trying to expand their exposure to AI as a sector overall? Personally, I don't see it as a major risk, but it's just something to think about in terms of the amount of financing that's gone into that.
Another area I just want to cover very briefly, because it's very big across the region, is crypto.
Yeah.
We've seen the drop in crypto quite dramatically, fell down from 10th of October when we had uncertainty around the tariffs with China kicking through, and it hasn't really recovered since. It started to drift back up, and everyone's been very nervous about it. But a lot of that has to do with what we're seeing, changes in regulation. How do you feel about crypto across the region, given the degree of embeddedness that we're seeing within this region?
Clearly, the take-up is very high here. We don't have the same degree of macroeconomic risks within the region as we see in other parts of the world that would warrant heavy use of crypto, yet it's still here. It's a younger demographics here, and they clearly have taken to the technology and the terms of trade that we see. In countries where there is quite a bit more currency risk, like Turkey, for example, that we've seen a lot more take up there, and I think that's going to continue. Now, I'm not somebody who's going to be able to call a value on crypto. At the end of the day, who knows who's controlling these currencies and where the ownership is and how much they decide to sell from time to time that moves the markets in a particular way. But the use is there. The technology is quite important.
And the point is that here it is a very welcoming regulatory environment for crypto users, and that is slowly changing globally. We've seen that in the US. We have the SEC looking at approvals of new crypto ETFs, which of course also at the same time in the US, pension funds are now allowed to invest in these crypto products. We've seen some opening in the UK, and there's new alignment happening across in Europe as regarding crypto. So essentially, at the end of the day, you're seeing a very positive growth scenario for the GCC region for at least the next 1 year, 5 years.
Beyond even, I think, like I said, structurally, this is a fantastic place to be in terms of having a very young demographic. They're just moving into the age where you start seeing a big increase in expenditure per capita, as you've seen in other parts of the world, at a time when the rest of the world is aging into the point where actually consumption per capita starts to come down. And that is going to be a big challenge. I do believe it's underappreciated here because they don't necessarily see the same problems that you have with regards to aging populations as you have in the likes of Europe and the US, China very badly.
Very much, yeah.
But if you're an international corporate that's looking for strong consumer demand growth, this is the region to be in. And with that, you also have, of course, the hydrocarbon resources behind you, backing all the infrastructure spending that's going to be going on for decades to come.
Because even if we look at the energy transition, this is something that's going to take decades to happen. It is.
Yeah, absolutely. And even still, the governments here and the companies here are also leading some of the technological advancements in that transition as well. Again, going back to the provision of energy for the AI companies and the data centers, they want to do it using clean energy and solar power.
Excellent. Well, thank you very much, Azad, for a fascinating brief look into what is happening within the GCC region. And I'm sure everyone will look forward to reading your report coming out in the next couple of days from Oxford Economics.